Yeah.
Is it still shared, the screen?
Yes.
Okay.
So Peter, I'm going to introduce you, but it's very TUM or TUD oriented for the CV.
That's not your fault. You might say it's my fault.
No, I mean your success, huh? Let's put it like this.
That's very kind.
All right, so we'll give it another minute, but I guess there's no one in the waiting room. Dinara, if I see it correctly, everyone is joining immediately because everyone has. Okay. So we'll give it another minute and then we'll get started. Oh, and Dinara, I have a question. I didn't check it, but the next session is on December 9th, and who will be our speaker on December 9th?
Who identified? Let me check.
I still have Professor Vishnu Pandey, but I think this changed. That's my last update, but I haven't.
Yeah, I was wondering about the same thing. Dinara, did we invited somebody else, but I totally
Oh, that's all right. I will.
I'll sort it out after today.
That's fine. I think it's just
last week, so now I'm catching up again.
Oh, good. Yeah. Are you feeling better? Are you traveling or you were?
I was in Colombia.
Oh yeah.
UN World Data Forum, very interesting, but
A long trip.
Yeah.
So we are just we're waiting for participants to join, and I can see that the participant list is growing. We'll just give it another minute for everyone to log in, and then we'll get started. So welcome to the Nexus seminar series. I'll just give it another minute or so, and then we get started. So I'll just give it another minute or so, and then we get started. Welcome to the Nexus seminar series. So welcome to the Nexus seminar series. I'll just give it another minute or so for everyone to arrive in this digital space, and then I get started. All right, so welcome everyone to today's Nexus seminar series. For those of you who are joining for the first time, to give you an idea what the Nexus seminar is. The Nexus seminar is co-hosted by UNU Flores, so that's the United Nations University Institute for Integrated Management of Material Fluxes and of Resources, with my colleague, Professor Serena Kürzi, and then together with the Dresden University of Technology, TUD, and in particular, PRISMA, the Center for Sustainability Assessment and Policy, which I represent. My name is Samantha Dijkstra-Silva. I'm the Karlovitz Junior Professor for Sustainability Assessment and Policy, and I'm really delighted to welcome all of you today. Some background information on the seminar. The Nexus seminar series was established by the two institutions in 2015, and it features speakers, particularly senior researchers around the topic of sustainability and the research nexus. And we're today in our 79th edition, and I'm really delighted to introduce Professor Peter Schäfer in just a moment. But before we start, a brief orientation for the participants in today's sessions. Usually the speaker first provides some insights of the work at the beginning, and if you have any topical questions, you can paste them in the Q&A session, which you'll find usually at the bottom of your screen. And then the question and answer section will be at the end after the presentation. Serena and I will moderate the Q&A session, and then you can ask your questions to the speaker And if you have any technical difficulties, you can use the usual chat function of Zoom. And then the Dinara and the colleagues behind the scenes will kindly facilitate the session and help you with technical problems. But without further ado, I'm really glad to welcome you, Peter, to our session today. Peter has joined TU Dresden in last year in July and is the professor for management accounting at the Faculty of Business and Economics. And prior to joining TUD, he was also at the Technical University in Munich and worked there as a postdoc and did his PhD there. And before, he studied, I think, a mix of both mathematics and business and economics. So a very technical, university-oriented CV. And I'm really glad that you accepted our invitation and are joining us today and sharing your insights with us. And I think you already shared the title of your presentation, which you should be seeing now, and that's on paying CEOs for environmental and social performance, what we know and what we don't know. And so with this, Peter, I'm very much looking forward to your presentation, and I would like to hand the presentation over to you.
Thank you very much, Samanthi, for that very, very kind welcome. Given the CV that you just summarized, I hope my speech, my talk won't be too technical, but I'll give my best. So let me try what is going on here. All right, that works now. All right, so I wanted to start with Christian Klein. He's actually the CEO of the largest, or you may say the most valuable German firm, which is currently IT provider SAP. Christian earned a solid 4.67 million euros in 2022, which to us probably seems like a lot. But if he meets his most important peer, who is his most important peer, perhaps the CEO from Oracle, which is Schäfer, he's really a poor guy because she got about $138 million in 2022. That aside, my story is not about what he earned anyway, but more what he may have earned. And I have that here on the next slide. This is still a bit puzzling. All right. He may have earned a 100,000 euros less if SAP had released 100 kilotons CO2 more in the atmosphere than they actually did. They emitted about 85 kilotons, but would it have been 110, he had gotten only 4.57 million, so 100,000 euros less. On the other hand, if he had managed to release 50 kilotons less into the atmosphere in 2022, he had earned an extra 80,000 euros. So his compensation contract includes the CO2 emissions of SAP. Put very simply, each kiloton of additional emissions had cost him about 4,000 euros of private salary. SAP is paying Christian for his efforts towards sustainability. And that's what I will talk about today. We call this usually ESG pay, so paying CEOs for environmental, social, or governance goals. Why may it be worse in the first place to think about ESG pay at all? Well, I guess the simplest and most important reason is because firms do it. Actually, I think it is currently the biggest branch in CEO compensation, in CEO pay overall. A little less than 15 years ago, we could find 100 firms across the 10,000 largest firms globally that used ESG metrics, which is actually 1%. But in 2023, we had about 76% in the S&P 500, so the 500 largest US firms who use such ESG pay, and it was around 50% in 2023 if we look at the 10,000 firms globally again. Importantly, of course, carbon emission, my example, is just one of many environmental, social, or governance metrics that firms use. Some of these firms, the 76% here, use metrics that would be related to employees, how happy your employees are, how safe their working environment is, or even how equally they are paid. Or other metrics are about customers, how satisfied they are with our products, or any other non-investor stakeholder like the environment, for example. So questions that arise, why do we observe this spark? Or does it actually work? Does it have any consequences? Does it foster the sustainability efforts of firms? Without preempting too much of my conclusion, unfortunately, for many of these questions, we don't have a clear answer yet. But let me the next, I don't know, maybe 45 minutes, give you a quick overview of what we know and some research results that we have about these ESG pay. Here's what I thought would be worth looking at. So my first question would be, who actually uses ESG pay, sharing some stylized facts about this phenomenon. And then I will raise the question, why do we think firms do that? Then third, do we get what we pay for? So if we pay for sustainability, do we actually get sustainability? And then fourth, looking a little bit into the critics, what is the trouble with ESG pay? What would critics mention is the problem about this phenomenon? And then finally, I will highlight what I think are the two most important directions to understand better why firms use ESG pay and how that works. So that is pretty much the plan, to talk a little bit about these 5 questions and what we know about the answers. Let me start right away with who uses ESG pay, what do we observe in practice, some more facts about ESG pay. And the first is what I already showed you. It is a huge trend, and it became a huge trend, particularly over the past decade. I think the race started around 2011. Until then, only very few firms integrated ESG metrics into their top management incentive systems. And it increased to around 40%, or as I said before, even 50% in 2022. And within the S&P 500, so the large firms, it's around 3 out of 4 firms already. But that said, and second, what we also observe is that the use of ESG pay, that trend strongly varies across industries. And if you look at some statistics that I brought here, it seems that firms in industries with specific sustainability or ESG issues, I say high environmental burden or particularly exhausted job for employees, they use more ESG pay, which kind of seems to be plausible, right? If it matters, you rather care about that. You rather think about, okay, should I incentivize my CEOs according to their ESG performance, like utilities or energies? Those are the business sector where, meanwhile, nearly each and every firm utilizes ESG pay. Or relatedly, at the top, you also see some sectors here that are under specific public scrutiny. You may want to say like real estate, financials, or even materials. Now let's zoom in a bit. So how do firms implement these ESG metrics into CEO pay? How exactly would they do this? My first question here was, do firms use ESG metrics for their annual bonuses or rather for long-term incentives? The background, if you're not very familiar with CEO pay overall, the background is that most companies use 2 kinds of incentives, right? The one is an annual bonus that often depends on the current year's profit or some other short-term targets. And the second component is a long-term incentive plan. And this long-term incentive plan is usually paid out in stock. So that looks at your performance over 3, 5, or even 10 years. And then you get stocks with the idea that this sets long-term incentives to create value for the firm. Well, we may say, or at least that is what I assumed before I looked into the data, sustainability goals are long-term goals. So I had expected them in the long-term incentive plans, but looking at the actual data shows kind of the opposite. So most firms add ESG metrics to annual bonuses. Around 86% only add these targets to their annual bonuses. Like you might remember the example of SAP there, the annual bonus of Christian depends on the changes in carbon emissions in that specific year. On the other hand, much fewer firms integrate these goals into long-term incentive plans. In total, that's 14% currently. A prominent example of a firm that does that, that integrates it into a long-term incentive plan is Siemens. So the Siemens CEO, Roland Busch, he gets more shares, he gets higher long-term incentives, the better he performs in a Siemens-specific ESG index, and that ESG index is comprises carbon emissions, learning hours for employees, and the customer net promoter score. So what share of customers are actually satisfied with the products or services of Siemens. Why do I think this short-term perspective is surprising? Well, it implies that these ESG goals, that these sustainability goals have a one-year horizon. Given that the efforts for sustainability are rather long-term efforts, requiring transforming our firms toward more sustainable, say, business models or supply chains or production methods. All these things are rather long-term efforts. So you may be surprised to see that the utmost maturity of firms uses that for their annual bonuses. And then my second question, zooming into that a little bit, is which ESG metrics do firms actually use? And the answer may again be surprising. My example, the carbon emissions that you might think many firms use, only 13% of firms do so. 42% use other environmental goals, but the majority of firms rather uses employee-related metrics like their safety, their security, their satisfaction, their diversity, or their inclusion. Maybe a few words about these other environmental goals. What are other environmental goals? For instance, Intel looks at water conservation. Dow, the chemical material producer, they look at waste intensity. Coca-Cola simply counts sustainability initiatives, just to give you an idea of what are these metrics that we talk about. Others are circularity targets, environmental incidents. Some use the clean revenue, so the revenue that you make with allegedly green products or related metrics. But still, among ESG pay adopters, the most important metrics, maybe somewhat surprising, are employee-related, their safety and their security. So let's go one step further. That you have seen some stylus facts. The next question would be, why do firms do that at all? Why do firms integrate ESG incentives into their CEO pay systems? There is a simple answer, right? You might say, obviously, we have finally realized it is important to care about the environment. It is important to care about social justice. So obviously, firms would want to motivate their decision makers to consider this. The problem is this answer falls a bit short. Why that? If people care about the environment, we need no motivation to do so. We need no monetary incentives to do so. So it's a little harder to find a convincing answer to the question, why do firms use that? Why do so many firms use that? I will show you here 3 economic reasons that research discusses. So how can the trend be the result of some economic rational behavior? But we should keep in mind, besides these economic rational reasons, there can also be reasons for ESG pay that is not economically a good thing. Most importantly, first, it might be the result of greenwashing by firms. They just might do that in order to appear greener. Or it could also be the attempt of CEOs to extract rents. Extract rents is kind of a technical term for trying to get more money. CEOs may believe we can more easily achieve ESG goals, so let's try to sneak them into our performance matrix. I will discuss these 2 non-economic explanations a bit later. For now, let's look at the 3 reasons that the literature suggests why firms may use ESG pay. The first reason could be that there is a business case for ESG, that ESG efforts pay off financially, right? Boards of directors who are in charge to define CEO pay, this is the compensation scheme of CEOs, they may believe ESG efforts will pay off in dollars. If this is true, if ESG efforts pay off, then actually ESG metrics just tell us something about the future success. Why may there be a business case for ESG? Well, customers may care about ESG, our employees may care about ESG, governments pay attention to ESG, so there may be future regulation such that that ESG performance actually decreases our future risk. So there might really be a business case for that. It may pay off in dollars. And if this is true, ESG metrics just tell us something about the future firm success only in monetary terms, right? They tell boards whether the CEO did things that are in the interest of investors, even if the investors do not at all care about ESG per se, right? In this explanation, they just do so because it pays off financially. And then we have a clear reason. ESG pay would motivate CEOs to do good, to create value. What's the problem with this argument? This is actually the argument I said before that won't go through that simply. Well, the question is, why do we need ESG metrics if financial metrics already reflect ESG efforts? So to capture whether a firm does good financially, we can just use stock prices. We don't need to look at ESG performance. And also stock prices are much simpler to measure than ESG performance, right? ESG performance is multidimensional. I have already shown you like 10 dimensions that some firms use. It has so many aspects. It includes so many trade-offs. It includes so many nexuses that it seems hard to measure ESG performance if we actually just want to capture financial performance. So the stock price would be a forward-looking performance measure. It incorporates even the future effects of current decisions, at least if our market participants understand and correctly anticipate them. So this is the major problem with that argument. Alex Edmonds and professor from LBS, from London Business School, put it in a nutshell. If ESG metrics are indeed relevant for long-term value, then tying pay to long-term value would be sufficient to encourage executives to bolster them. So with that main argument, we may struggle a bit. Why would we use specific ESG incentives? Well, there is one reason that may save that argument, that may actually create a gap for ESG pay. ESG pay may be helpful if markets are not efficient, and by markets are not efficient, I mean that investors do not immediately realize the ESG benefits. So if I do something for the sustainability of my firm and investors, stock markets don't realize the benefits, they will only come clear in a couple of years or even decades, then it may make sense to integrate these goals into CEO pay. The problem is this is a pretty strong condition because assuming that markets don't understand the benefits of sustainability efforts would also imply that those investors who do understand them can earn excess returns. So that would actually be a story that allows us who understands the importance of sustainability, even for future financial success, can earn excess returns. One important thing, one final comment to note about this explanation is it does not require that investors care about ESG specifically, right? Even if investors would not be interested in sustainability, they are not interested in carbon emissions or whatsoever, that would be a perfect economic explanation why we would see ESG pay, simply because it is a proxy of future success. But actually, investors may care about ESG. And this brings me to the second explanation that we discuss why so many firms use ESG pay in their CEO compensation. Investors may care about sustainability, about their carbon emissions, for instance, and they believe their CEOs care less about these goals. So if investors care but think CEOs care less, then they may use ESG pay in order to help motivate CEOs to care about ESG. I think it's important to be very clear here what caring about ESG pay means, what having other preferences means. That really means I would be willing to give up some money to improve my company's ESG performance. right? I might be willing to give up, say, $10 of my return as an investor if I know that then the firm emits, I don't know, a ton of carbon emissions less. And this number, these $10 that I'm willing to give up in order to save our environment from our atmosphere from 1 ton of CO2, this number may differ across people. And this is really the core of this argument. Maybe CEOs are willing to give less up for a ton of CO2 than investors. And then ESG pay may be the vehicle to align these goals. The idea ESG pay aligns the interests that would otherwise be different. There is also a problem with that argument. It would only explain ESG pay if CEOs systematically care less about sustainability than investors, right? It is not clear why CEOs, who are also investors, by the way, would care systematically less about ESG or about sustainability overall than others. There is one argument why we may still see ESG pay, even if the intrinsic preferences of investors and CEOs are similar, if there is no ex ante need to align any deviating interests, and that may be the compensation of the CEO itself. So here in this table, I compare an investor and a CEO who are very, very similar. They both would have an intrinsic willingness to pay of $1 to save 1 CO2 ton. And they both own shares which make up 0.01% of all the firm's shares. So they have the same share in the firm, and they are also very similar in their intrinsic preferences. But then CEOs have very powerful incentives, very powerful bonuses. So it's very realistic to say our CEO may have 1% effective ownership. What would effective ownership mean? Effective ownership means if the value of the firm, the market value of the firm, decreases by, say, $100,000, the wealth of the CEO decreases by $1,000. And this is actually something that we wanted, right? Researchers and investors and boards and governance, we fought for years that CEOs have a high effective ownership because they should be punished for bad performance and they should benefit from good performance. But now, if we think about projects that may save CO2 emissions, what happens now? Even though both of these parties, the investor and the CEO, they are very similar, the maximum price that the investor would be willing to pay for a reduction in CO2 would be $10,000. Why? The investor, say she owns 0.01% of the total firm, her willingness to pay is $1. So for all of the firm, she would be willing to give up $10,000, but the CEO would only be willing to give up $100 because of his or her powerful incentive system. He or she would have to pay 1% of the price, making him or her willing to pay only $100. And that may be a reason to say, okay, then we need to add specific additional incentives for CEOs to avoid, in my example, carbon emissions. That would be the second potential reason why we see that spark. And there is a third reason that some researchers suggest why we observe that a strong interest in ESG pay may simply be the case that firms want to signal commitment, right? Many firms have made pledges about what they will do in future to improve their sustainability efforts. Like, I don't know, we will achieve net zero emissions by 2050, or those who are more ambitious, we will achieve net zero by 2035 or something like that. The huge question is, many wonder, are these pledges credible? But using ESG pay may be a means of firms to lend credibility to these pledges, right? If you tie the pay of your most important decision maker to whether she or he improves sustainability, these pledges may appear more serious. However, there's also the flip side of this coin. Many may wonder, is it actually a credible signal, or is it again just greenwashing? And this is unfortunately very hard to disentangle empirically. I'll come to that back a little later. So we have basically three explanations. First, companies do that because they want to be more successful in financial terms, and ESG is just a proxy for future financial success. Second, firms do so in order to align the interests of the, say, greener investors with the CEOs who have a weaker preference for sustainability, or firms predominantly do so in order to signal commitment. Do we have evidence that would help us disentangle these reasons? Well, what research has done so far, research has studied which firms use ESG pay, hoping that which firms use ESG pay tells us something about why firms use ESG pay. And the big picture, unfortunately, seems to be that the evidence is consistent with each of the three reasons. I'll show you what research has done. So we have tried to figure out which firms use ESG pay, and largely we find, or the literature finds, four answers to this question. The first is corporate governance matters. Firms that have a strong governance system, for instance, a lot of independent directors in their board of directors, or larger boards or more diverse boards, they use more ESG pay. And maybe surprisingly, when the CEO is less powerful, then firms use less ESG pay. So that direction is actually negative. A less powerful CEO leads to less ESG pay. Then the literature detects other firm level factors that matter. Firms with higher stock volatility, larger firms, and firms with ex-ante higher emissions, they use more ESG pay, which seems to make sense. And then third, country level factors matter. Countries that have strong disclosure mandates about ESG, carbon emissions in particular, they adopt ESG pay more often. And if people are more sensitive towards sustainability questions, firms are also more likely to adopt ESG pay. Finally, we see a similar pattern on the industry level. Firms from industries that are more burdensome, we have seen that already, to the environment, they are more likely to adopt ESG pay. Now, what can we learn from these patterns about the explanations why firms adopt ESG pay? As I said, the short answer is the evidence is somewhat consistent with all three economic explanations. Just let me illustrate that very shortly. If you talk about the first explanation, there was ESG pays off financially, and ESG metrics actually tell us something about the future success of a firm, then we see that indeed firms for which ESG performance may pay off better, those who initially have higher emissions, those that are in countries where people are more sensitive to sustainability issues, and firms in industries that put more burden on the environment, they are more likely to use ESG pay. That would perfectly fit the first story. ESG just tells us something about how successful the firm will be in the future. And also firms for which financial metrics are a more noisy, a less precise indicator of firm success. So firms that are more volatile, where stock prices are more volatile, they use ESG pay, which also suggests that this is just a better proxy or an additional proxy of future firms' financial success. But the evidence is just as good with the explanations 2 or 3, so that firms try to align interests or try to signal how important sustainability is to them by adding such ESG pay components. For instance, it is stronger if there are more institutional shareholders. Institutional shareholders like banks or insurance companies, they have the power to actually realize any differences in their customers' preferences and the CEO preference, and to push through ESG pay. So that would be an argument for explanation 2. And on the right-hand side, this also fits the explanation 3. Those firms that are in more ESG sensitive countries or in more ESG sensitive industries, they want to signal more commitment to ESG goals, and thus may be tempted to just say, okay, look, we even pay our CEOs depending on how well they do about sustainability efforts. One remark here, of course, this pattern is also consistent with the greenwashing argument. Firms in ESG-sensitive countries and ESG-sensitive industries and firms under higher public scrutiny, those who emit a lot already, they would also have the highest incentives to fake the commitment. So the question actually to shed light on whether it is greenwashing would be, is the signal costly to mimic? Does it cost firms anything to adopt this ESG pay? One way how it would be costly if it actually has consequences for the firm's operations. We will see something about this in a minute. Before I turn to that question, you may wonder, why don't we just ask firms? Why don't we just ask firms, why do you use ESG pay? And of course, people do that, right? They conduct surveys, they ask directors, they ask the management. The question, though, is, are firms willing to share the true reasons, right? You would definitely not say, we do that for greenwashing. And you would perhaps also not say, we do so in order to set incentives for our CEOs to care about sustainability, who otherwise wouldn't care about sustainability at all. That is definitely something you wouldn't share. But if we do ask firms, and the conference board did so in 2022, their answers kind of fit the picture that we have from the theory and the empirical evidence. So first, the commitment story seems to be important. Most firms, it's a top answer, say, signaling that ESG is a priority is why we do that. Whether the signaling is just greenwashing or whether it's credible, we don't know that. And then second, setting incentives also seems to be important, as more than half of the firms say, okay, we respond to investors' expectations, or we do so in order to achieve ESG commitments that we have made. One additional non-economic explanations that comes up here is to keep pace with peers, which is not really an economic explanation, but an argument that we observe quite often in practice. We have heard the same argument with previous trends in CEO compensation, like option pay, for instance. And this is something that concerns me personally a bit. So is this just another trend that everyone does because others do it? Or is it actually a meaningful trend that firms do because they carefully consider what is the best way to incentivize our CEOs? That this is something that we have to figure out in the future. Well, with that, let me come to my third question. The third question is, do we get what we pay for? What do we know about the effects of ESG pay? So do firms which pay for sustainability actually get sustainability? I think this would be particularly interesting with regard to the greenwashing concerns. If we see it actually changes something, then this ESG pay would at least be a credible signal in the sense that it is costly in some sense, costly in the sense that it changes something within the firm. Here is the very, very high level, big picture of what the literature has found. I'd say that is the best researched question we currently have about ESG pay. So first, there is indeed a positive association between ESG pay and ESG performance, right? That's what we would expect. Firms who pay for sustainability seem to become more sustainable in their operations. In addition, the literature has tried to figure out whether ESG pay is also associated with financial performance, but overall, this literature couldn't find consistent evidence for this. This is kind of my personal summary of that literature. There are some positive effects. There are also some negatives or some research that finds no effects. Overall, I would say researchers who hope that we would find evidence that ESG pays off and ESG pay is a vehicle to foster it, we don't see that consistently in the data. But zooming into the first part here, that ESG performance part, we see that firms that have paid for ESG performance do better. They obtain higher ESG rating. We observe more sustainability initiatives in firms that use ESG pay. We see less carbon emissions, or you might also say higher reductions in carbon emissions. And we even see more transparent and more extensive sustainability reporting in these firms, which may speak somewhat against the greenwashing argument as the primary motivation, because if ESG pay actually has effects, then the signal is not costless, thereby it might be a meaningful, a credible commitment towards the sustainability pledges that a firm has made. There is unfortunately a strong problem that we have with this evidence. All these, or most of these studies, are mainly observational. They observe associations, firms that pay for ESG do better in terms of ESG performance. The huge challenge is that the contracts that we observe, so the decision whether to use ESG pay or not, is obviously something that firms do by themselves. And we already know which firms choose to use ESG pay. Those that care a lot about ESG in general, or that for firms for which ESG is important in general. So our association studies cannot really disentangle whether these firms do better in terms of ESG performance because of ESG pay, or simply because of other ESG efforts they do, because of the preferences, the general preferences that these firms for ESG have. And unfortunately, we cannot observe that. So we would like to control for these things in studies, but this is really hard to disentangle. That's a standard endogeneity problem that we have in many research strands, and especially if we talk about CEO compensation, right? Firms choose their CEO compensation by themselves, and clearly they consider all the factors that may render the one or the other component beneficial in our example, that may render ESG pay beneficial. So do we observe these benefits from any other efforts that also make or motivate firms to use ESG pay? Or is there actually a causal effect of ESG pay on ESG performance? I think that is the question that we would really like to answer in order to inform investors, inform boards, or even inform governments who might think about making that mandatory when it comes to these questions. What is the current approach to tackle this endogeneity issue? Well, the main approach is that researchers try to utilize regulation, try to utilize variation in ESG pay that stems from regulation. I'll give you an example. One way are these state-level constituency stages. What is that? Well, in some of the US states, the constituency stages demand board of directors, corporate boards, to also consider stakeholders, the environment, employees, suppliers, when they make their decisions. So for these, or for firms in these states, it might be easier to push through ESG components, ESG metrics in CEO pay. And that variation that comes from this regulation might be less related to firm-specific other efforts or other preferences. Other regulations that researchers tried to utilize here are, say, on pay laws. Say on pay laws are laws that make it mandatory for firms to ask their investors whether they like the CEO pay system. And the argument goes like that: if investors care about ESG pay, then if we allow investors to have a louder voice about CEO compensation, then they will push through more ESG pay. And this again might be less related to other preferences or efforts. If we look at these works that try to utilize, make use of these variation in regulation, they pretty much confirm the previous results. We see still more environmental initiatives and still stronger reductions in emissions if we utilize this variation in ESG pacing, if we utilize regulatory differences. The problem is this regulation may still be correlated with ESG preferences. In that case, ESG preferences not on the firm level, but on the state or the country level. Of course, New York has such a constituency stated saying you should care about other stakeholders than investors. Maybe not very surprisingly, Texas has none. But with all due respect for taxers, there might well be other reasons why New Yorkian firms care more about sustainability than Texan firms. So I think the summary here is we observe strong associations, but there are also good reasons to believe that they are mere correlations, and we still lack causal evidence. So how ESG pay actually changes the decision-making of CEOs or other executives, this is still kind of a black box. Which brings me kind of to my fourth question, which was, what is the trouble with ESG pay? So what is the main critics? What do critics, what concerns do critics raise? I'll show you the two critics that I think are brought forward most frequently. The first concern is ESG pay may help CEOs to earn excess pay. What is excess pay? Excess pay is a term to indicate that CEOs earn more than labor markets or their performance would suggest. So excess pay is anything that you earn because you are so powerful in your firm as a CEO. You have better information than most other parties, and that may allow you to earn excess pay more than markets would allow or would suggest. So ESG may actually be against the interests of investors and instead be a way for CEOs to get higher compensation. The story of the critics who raise this concern is, over the last decades, many governments around the world did a lot to improve how efficient CEO pay is. Mainly they increased transparency. They gave shareholders, investors a voice in the pay setting process to make that more transparent, fairer, and ultimately more efficient. Now, ESG pay may actually be a vehicle of powerful CEOs that they use to distort the pay system to their own benefit, to earn excess pay. The three main arguments of these critics are, first, manipulation. ESG metrics may be easier to manipulate than traditional financial metrics. Second, weak disclosures. What we observe if we look into the compensation reports, disclosures about ESG metrics are often kind of vague, and often companies would not tell us the exact weights or not even the exact metrics being used. And then third, if you look at the years in which ESG metrics were adopted, some people say that is not actually a trend, but these are crisis years. CEOs may try to adopt ESG pay in years when financials turn out low. So ESG pay may undo the progress that we have made in transparency and pay for performance sensitivity. Pay for performance sensitivity just means how much I earn really depends on how well I perform. Well, what evidence do we have on this question? This might be the question where we have the clearest evidence, and this evidence kind of speaks against this concern. Why is that? Maybe you remember we observe that firms with strong governance systems, strong control systems, use more ESG pay. And vice versa, firms with more powerful CEOs, firms in which the CEOs have a stronger information benefit, are more powerful overall, use less ESG pay. But if it is actually a vehicle of CEOs to get more money, we would expect kind of the opposite. We would expect that, especially in firms where the governance systems are weak, we would have more ESG pay. So this is a critic that is often raised, but I think as of now, I would personally be most confident about that we have clear evidence against this, at least what we know so far. A related concern is the greenwashing arguments that I have mentioned once in a while. So an argument against this is that ESG pay is actually associated with higher ESG outcomes, which would suggest it is rather not greenwashing, but I'll come back to that again. The second critics is ESG pay actually causes unintended consequences. It does not do what it is supposed to do. And the main reason for that argument is ESG metrics can, by their nature, capture only narrow aspects of full ESG performance. The ESG performance actually has so many dimensions, and you cannot incentivize all of them. So by using ESG pay, you actually do worse instead of better, because ESG efforts actually involve a multitasking problems with a lot of nexuses, with a lot of trade-offs, and you cannot incentivize all of them. Or maybe even more important, you can measure some of the dimensions more easily than others. And if you think about, okay, how can I add an ESG metric to my CEO compensation, you will be tempted to use those that are easier to measure. And you will forego the dimensions that are harder to measure. And this is actually a core result of Nobel laureates Bengt Holmström and Paul Milgram. I think I have that down here. In such a situation, if you have a multidimensional problem, if you have a multitasking problem, CEO working for many different ESG goals and of course also financial performance, then it's actually worse to incentivize only some of them and to incentivize just those that you can easily measure. I'll give you an example from the literature to illustrate that. One ESG dimension is diversity and inclusivity of the work environment. And you can very easily measure the demographic diversity of your workforce. So if you look at the compensation systems, there are quite some firms that use demographic diversity as an ESG metric. However, on the other hand, it's very hard to quantify or hardly ever quantifiable whether your corporate culture is inclusive. How do you want to capture that? So by paying for demographic diversity, firms may make CEOs focus on this and ultimately make them care even less about inclusivity than they would have done without any ESG metrics. So that's the second core critics. You may actually induce unintended consequences. You may even do harm to stakeholders by incentivizing the dimensions that you can easily measure. Lucien Babchuk from Harvard Law School, who brought this forward, said by incentivizing CEOs to improve the performance of narrow, quantifiable metrics, companies create distorted incentives to neglect other significant but hard to quantify dimensions. Unfortunately, we have not any evidence about this problem yet, I guess. But we have good evidence for the phenomenon I'm describing overall. For instance, from schooling. If you incentivize teachers according to the scores of their students in tests, then these test scores will increase, but many other dimensions will decrease, like for instance, social skills of the students. So we observe that in incentive systems, and it would be very important, I think, to understand whether this also happens in CEO incentive systems. Which brings me to my final questions. What do we not know? Or rather, where do we need additional evidence? Where do we need to get better to understand this phenomenon ESG pay? And maybe most importantly, to help firms design better incentive systems, right? This is what we ultimately want. We want to help firms to improve these CEO incentive systems, may it be with or without ESG pay. Maybe one disclaimer here. This is obviously my very subjective perspective. So I will raise two open questions that I consider most important, but others who talk about these topics may come to different conclusions. I personally think we need to start quantifying ESG pay. I believe we can only understand ESG pay and especially the effects that it has if we move on from just distinguishing firms that do or don't use ESG pay. So most of the evidence that I showed you just distinguishes would a firm use or would it not use ESG pay. But then from the more descriptive evidence, we have seen that ESG metrics that firms use and the way how they use these ESG metrics in CEO compensation is pretty diverse and differs across firms. So I believe these issues connect to each other. I believe to understand ESG pay and its effects, we need to zoom into the pay systems more deeply. For instance, how important are ESG goals in CEO pay? What weight would they make up? Or how sensitive is CEO pay to ESG performance? Or maybe in the first place, which metrics are actually used? Some first steps have been made here. Just two examples. Atif Ikram from Arizona, he has distinguished whether firms use subjective or objective measures. So objective measures would be measures that you can depict in a formula where you can say, okay, your compensation depends on, I don't know, demographic diversity with the following formula. And subjective measures would be used by firms to say there is kind of an index that is defined by our directors or someone else, and we will make an adjustment to your pay depending on how well you do about sustainability. And their research has actually shown that firms with better governance, systems, they are more likely to use objective measures. And in turn, objective measures have also a more robust effect on ESG performance. I think that is the direction we need to go forward. David Walker has tried to measure the weights, which is also, I think, a promising approach. So what weight in the total incentive system is made of ESG metrics, and which weight is made of financial metrics. Unfortunately, he could figure that out only for about 20 firms, but there, the median weight of ESG metrics is just 0.2%. I promised to come back to the greenwashing argument, and I think that is a good point. Seeing that the weight is so low on average or at the median, actually the average is a bit higher because there are one or two firms who put a by far higher weight on ESG pay, but the median is that low. That made, again, raise concerns. Is it greenwashing? Is it just that firms want to showcase we care about sustainability and we care so much that we even use it for the incentive systems? But I guess this is still an open question. The core problem in moving forward with these weights is first that many firms do not even disclose that. And I think this is one of the most important points if you think about governance and governments and the regulators. We need to find ways to make firms better disclosing the weights of these ESG goals. And then second, even if we have these weights, they are hard to interpret because a weight is either a weight in the target compensation or it is a weight in the actual compensation. What's the difference? The difference is the performance. How well did we do in these metrics? But both is problematic because when we use weights and we use actual weights, then these depend on the performance. Right? If I do very bad in sustainability dimensions, and if I do very good, if I do very well in financial performance, then the weight would be lower than it actually is. But if we use target weights, they can actually be affected by firms. Right? Without changing the pay system, the actual contract that you have, you can just make the target weight appear higher by changing the targets and changing the sensitivity towards these ESG metrics. So what I think, this brings me back to the actual suggestion, we need a standardized measure of how sensitive CEO pay is toward ESG performance and its dimensions. Something like what I did on the very first slide could be helpful here, right? I show you Christian Klein would earn 4,000 euros less if SAP had emitted a 1 kiloton CO2 more. That would be something that you can actually compare. And I believe this is also a way forward when governments think about how firms should improve the disclosure about ESG pay. Second thing that we don't know, I think we need a better understanding of the effects of ESG pay. I talked about the endogeneity problem in identifying the effects of ESG pay. So I think we need methodology-wise improve our causal understanding of ESG pay's effect. We need to become, I guess, more creative to identify exogenous variation in ESG pay design to understand what really happens if you choose to adopt such a pay component. So are there factors that make some firms choose ESG pay and makes other firms not to choose ESG pay? And these factors should be kind of random, meaning that it should not be related to economic factors within the firm, like the general ESG preference or stuff like that. And second, even in this, for this question, we need to move away from ESG dummies, like a firm uses ESG pay or it does not use ESG pay, but we need to use what I frame pay for sustainability sensitivity here, the $4,000 in the case of Christian Klein, need to use that as the independent variable and understand, does it matter more if it actually, if these metrics actually matter for the CEO and her or his salary. And then topic-wise, I think the most important thing is we need to test for side effects. Are there such unintended consequences that theory suggests should be there? So how do CEOs deal with trade-offs that arise from ESG pay? Do they forget about dimensions that are not captured, not covered by their ESG metrics in their compensation system? Going with the example that I made before, so if firms incentivize demographic diversity, do they end up with less inclusive corporate culture? I don't know of any tests of these potential severe side effects, and I believe that is really something that we need to understand to help firms make better compensation contracts. You may even say it is kind of concerning that so many firms do that without having understood what really happens if you do so. And I think we should really understand that, especially given that there are already some voices asking for governments making such components mandatory. So that was a quick run through some aspects I think is important. Let me underline 7 takeaways that I think are important. So first, ESG pay booms. A lot of firms use it. Second, to my surprise, currently ESG metrics are rather short-term than long-term, and I thought that would be surprising because the goals behind the sustainability goals are typically goals that you achieve by long-term efforts, not by short-term efforts. Third, firms with strong governance use more ESG pay. So that is actually a response to those who are concerned that CEOs misuse these ESG metrics just to earn more money. Fourth, a potential reason for ESG pay may be to set incentives for financial success, but also align CEOs and investors' ESG preference if they should be different. And we have actually evidence for both. Fifth, ESG pay is associated with better ESG performance. Put simply, firms that use ESG pay perform better in terms of sustainability, but we have little causal evidence that might be more associations because those firms who care about ESG choose ESG pay. Sixth, ESG pay inevitably fails to capture all dimensions because some ESG dimensions are hard to measure, and we don't know yet whether we actually put stakeholders at risk by using ESG pay. And seventh, finally, I think we urgently need a standardized way to measure how important ESG goals are in pay schemes, especially to help regulators, to help governments to make ESG pay a more transparent thing, to make it more transparent how important these goals are in the actual incentive systems of CEOs. I think those are the most important takeaways of what we currently know about ESG pay. Also made clear there is still a lot that we should learn in the future. And here are the references that I have cited on my slides if you want to look up the one or the other evidence in more detail than what I could show in these, I realized, nearly 60 minutes. I'm sorry, but now it would be a good time for you to raise your questions.
Thank you
Thank you very much, Peter, for the insights and for sharing. sharing your work today. We already have 2 questions in the Q&A section. I will ask them in a minute. But before I do that, I would also like to invite all of the other participants to make use of the Q&A function. You can just type your questions in there, and we'll be posting the questions to Peter. But before we deep dive into the specific questions, Serena, I think you might have an overall question for Peter as participant of the Nexus seminar.
Yeah, thank you, Peter. This was very insightful and very interesting. And I think you very clearly pointed out how narrow the SDG metrics are. So, I mean, from a UNU Flores perspective, where we want to look at resources in an integrated way and not narrowly look at things, do you think it is even possible to measure these things, or does it become too complex and all the data that you need to measure these things? What's your opinion on that?
Yeah, as I pointed out when I talked about the critics, and I share this point. It is obvious that some dimensions are easier to measure than others, and it is also obvious that firms are tempted to measure and incentivize the things that they can easily measure. What I may have not made clear enough, but what is part of what we know in such a situation, we can even harm those goals that we believe we can measure easier, or the goals that we actually have in mind. Thinking about the atmosphere, toxic gases that we may emit, thinking about water usage, thinking about the disposal of other hazards into the environment. It may well be that we incentivize decision makers in firms to do the other thing that we do not consider in our ESG metrics, and instead, for instance, decrease the carbon emissions. Sometimes they are even substitutes, and it might be very, very, very easy to think about examples where we go into other dangers for the environment because we are incentivized to reduce, let's go with my example, carbon emissions. So I think that is really a problem. I think your question was kind of, what would be the solution? I don't know. Some opponents say the solution is to get rid of ESG metrics overall and to solve the issues through other vehicles, like making CEOs care about financial performance, and as governance, make sure that those who do not care about sustainability won't be successful in financial markets. I think this is also what regulation currently pursues. But then again, I mean, you might ask the same question for governance and firms. Isn't it as hard for governments and firms to internalize these external effects that we are talking about? And I don't have a very good answer to that.
Yeah, really interesting. So it becomes really a philosophical question there, but let's hand over to Samanthi that we can also answer the other questions.
Thank you, Serena. And the first one has a number of questions, and I'll just read out the whole statement, Peter. So is CEO pay related to financial performance at all? What is the evidence how it is measured? Of course, high profitable companies pay high remunerations as it is linked. As it is linked. But without this link, is the research on, let's say, similar CEO pay a different financial performance?
Yes, there is, I'd say, meanwhile, convincing and strong evidence that CEO pay depends on financial performance. First, there is direct evidence. You can open the compensation disclosure that firms have to make. You can clearly see how the total compensation is made up, and you will see that a huge part of that depends on financial performance. There is a second, a more indirect approach. You can request in a panel of CEOs and years how much they earned and how well they did in some financial dimensions, and you will find a strong association. Like Meanwhile, 50 years ago, there were two prominent authors in the US who said there is actually no pay for performance. Their key sentence was CEOs are paid like bureaucrats. And I think back then, this might have been true for many firms. But since then, a lot changed. So investors got a louder voice. Firms were made to disclose more details of their compensation systems. And overall, I think we have strong evidence that nowadays financial performance matters for CEOs and how much they earn, for the better or the worse. But descriptively, that is what we observe.
Thank you, Peter. And Matthias, question was for Matthias, who also raised his hand. Matthias, just feel free to add this to the Q&A if you have a follow-up question. And then I will continue with Juliana's question, who asks about what are your thoughts on linking sustainability metrics to employee performance indicators and incorporating them into compensation structures?
I should make sure that I understand the question correctly. A potential way to interpret it is so among potential sustainability metrics, what do I think? How important are such metrics that concern employees? An alternative way, and maybe you may clarify that, would be should we take care of how well employees actually perform when talking about CEOs? That would be an alternative. Let me start. Yeah.
So my interpretation is, Peter.
Right.
So what I thought, and Juliana, please feel free to add this.
Please.
Is essentially kind of copying the system and adding sustainability indicators and sustainability goals to the incentive and compensation of employees as well.
Oh, right. Oh, sorry. Right. That makes that.
That's just my interpretation. I might be wrong.
Right. That makes a lot of sense. And I mean, your interpretation makes a lot of sense, and the practice may also make a lot of sense. Actually, this is something that firms do, at least on the business unit level. Juliana clarifies. Oh no.
You're on track for the right
answer. A bit struggling. All right. Okay. Good. Good. So and firms do that. A prominent example, because they were early with that practice, is Microsoft, where on the business unit level, employees have to pay kind of a fee if they are responsible for carbon emissions, for instance, by using planes to go to their meetings or whatsoever. And I believe it is a powerful tool. We don't have very much evidence, I have to say that, but we have evidence for similar non-financial metrics in employees' performance systems, and we know that they work. So we can reduce carbon emissions by making employees responsible for the carbon emissions. And there is one advantage of employees other than executives. You can more clearly define the dimensions in which they can do good or bad, right? The carbon emission being the most prominent example. And if you can define that, these dimensions in which they can actually control what the firm does, I think the evidence that we have about other dimensions than ESG is enough to say, yeah, that is perhaps a good idea. And we lose these potential side effects because the trade-offs are not as manifold as when we talk about executives. So the short answer would be, yeah, I think that could be a good idea insofar as employees have an actual effect on the metrics, like the carbon emissions by using the plane or using the train.
Well, thank you, Peter, for your answer. And then Juliana has another question. Are there examples of how governments actively promote the integration of ESG-linked pay in company compensation structures?
I think not specifically the integration of ESG-linked pay. So I wouldn't know of any governmental initiative that like officially explains that they attempt to increase ESG-linked pay in CEO or other executives' compensation systems. Nevertheless, governments do a lot of things that foster ESG pay in CEO pay. One example being transparency about sustainability efforts. If you think about the EU NFRD, obviously firms, by being forced to measure and making these dimensions transparent, may be tempted to also say, okay, now that I have that information, I may just as well integrate it into my compensation systems. And then, I mean, we have talked about the state level constituency stages. By telling the directors who are responsible to write the compensation contracts, if you want to, you open the door for them to say, yeah, in order to fulfill this duty, to care about stakeholders other than investors, I use ESG pay. So I believe that governments do things that lead to ESG pay, but I don't think that it is their declared goal to foster ESG pay.
Thank you, Peter. And then I have one question, and with regard to the time, I would also suggest that this is the last question now. And the question is there any evidence or knowledge in general what percentage of the CEO incentive is linked with ESG pay, or does it also depend, I think, on certain factors?
Yeah, all right. That is a very important question, and this is also something I try to indicate that we don't have a good answer yet for several reasons. Researchers try to figure that out with all the data they have, but many firms do not disclose that. So you may say, I use an index to capture the performance of the CEO, and that index includes carbon emissions, the net promoter score, the EBIT as a financial goal, and I don't know, employee safety, for instance. But some of them do not disclose the weight of these 4 targets, such that it is actually hard to capture. Those who have tried to figure that out find on average very, very low percentages on CEO incentives linked to ESG pay. My example on one of the slides, I guess, was 0.2%, like 99.8% would then be tied to financial performance, which I should put into perspective because CEOs have huge huge shares of stock, right? They get a lot of stocks once they start their work in a specific firm. And to equalize the strong financial effect of these stocks, you would really have to put a relatively high weight on CEO, on ESG metrics. And I would like to add one thing. The answer to the question, what percentage is linked to ESG pay, may also sometimes be misleading. If you measure that ex post, so what the CEO actually earns, it clearly depends on how well she or he does in terms of sustainability. Let me use that term for the overall ESG metrics and the financial performance. So that measure would also be kind of distorted. That is why I tried to argue for a number, as the one I used in the beginning, these $4,000 that Christian Klein could earn more or less if he had managed to reduce the carbon emissions further, would be a better measure than the actual percentage. But even harder to measure given the multi-dimension problem that we have, and we try to capture ESG overall. So we may also want to go forward and define more specifically what metrics we are interested in. I hope that helps a little bit, even though I don't have a clear answer to the specific question.
Thank you very much, Peter. So really, thank you for taking the time and giving us a glimpse into your work.
No worries, it was a great pleasure.
And then also thank you to the participants for taking your time and engaging with Peter today. And you're all very much invited to our upcoming Nexus seminar session, which is taking place on December 9th. And so with this, together with Serena, thank you again, Peter, and I wish you a great week and see you next time.
Thanks, Peter.
Thank you. Have a great day.
Bye.